This chart, available at Veritas Alpha, illustrates a very high return on equity with multiples so compressed you can hardly differentiate between them on the graph. This is highly unique. You can look through the 6,500 page report. It's hard to find a graph that looks quite like this. And as sentiment returns, we will see growth in earnings and we will see multiple expansion, which gives us potential for enormous growth in price. Alibaba is a case where we wanted to own the business, but we could also get a better deal on the stock when we apply structured value. So instead of buying the shares outright, we sold a series of puts as a tool to buy the equity, and that pays us up front for our commitment to buy the stock if the price declines further. So you can think about this a little like selling insurance on a company that we want to own. So in this illustrative example, and you can look and basically do this currently, we collect $30 up front. So the stock is selling around 120. If we want to buy the stock as a retail investor, we just put in a market or limit order and pay about 120. But there are other ways to do it. The structured value method. We collect $30 up front as a premium and put a strike price of 120, committing us to buy it for 120 over the next couple of years. And if Alibaba's price falls below 120, we're pleased to buy the shares for a net cost of only 90. The strike price minus the premium that we've received. So this is a bargain. And some people will recall we also can utilize techniques like tax loss harvesting to capture short-term write-offs for our partners. Now, I know James Ebert's on the call, and last year he was an intern for us, and he converted some of these highly complex strategies into musical notation so we could pass the knowledge on to a broader audience. Here we use our open circles to reflect opening a position and close circles to represent expiration or closing out a position. And in the first measure here, this is what we've done with Alibaba. And in the first measure, we repeatedly sold puts until we gained our desired equity exposure. And as the price of Alibaba declined below our strike price, we were able to sell short-term calls in the second measure as a technique to minimize the losses and capture short-term tax write-offs as we exited the stock that had declined. But at the same time, the business was thriving and we were able to buy very inexpensive, long-dated call options, providing enormous upside potential that go out until December 2027. So this structured value approach turned a good investment into a great one by tilting the odds in our favor. And we wouldn't have achieved this kind of risk reward by simply buying the stock at market price. By selling the puts, instead of just buying the stock, we create this scenario where we benefit from several directions and potential outcomes. So now that I've shown you how structured value can enhance the returns, let's talk about how we uncover these unique opportunities in the first place.